Right, good afternoon everybody and welcome to the first in the series of the BDB Pitmans Cryptocurrencies webinars. We're delighted to see such a good number of you attending today. My name is Lucinda Brown and I'm a partner at BDB Pitmans specialising in trusts and estates disputes. I'm joined today by two partners from our private client services team, Helen Ratcliffe and Marilyn McKeever. Both Helen and Marilyn have an international client base and have extensive experience in tax and trust advisory work, both onshore and offshore. Helen and Marilyn are joined on the panel today by our two esteemed guest speakers working in the cryptocurrency space. First is Leigh Sagar, a barrister from New Square Chambers. Leigh is a barrister of England and Wales whose practice includes advising on estate planning, administration, taxation of Bitcoin and other cryptocurrencies and tokens, and related litigation. He is the chair of the STEP Digital Assets Special Interest Group, and he has written a book called The Digital Estate, which is a resource for crypto asset estate planning and administration. Our second guest speaker this afternoon is Duncan, Counsel with Carey, Olsen in the Cayman Islands. Chris advises clients on both non-contentious and contentious trusts and private wealth matters, with a particular focus on high-value advisory and restructuring work and trust disputes. Increasingly, Chris is advising clients in the tech and crypto space, helping to establish pre-IPO and pre-liquidity event structures and structures to hold and promote crypto and crypto proceeds. Chris has been writing and speaking about crypto and the private wealth space since 2015, making him a go-to advisor for crypto clients. I think we'd all agree that cryptocurrencies are a hot topic in the global financial system at present. Hardly a day goes by without a news item relating to the volatility of the market, the environmental issues, the scams, the risks, and ways in which investors can maximize their gains. There is great volatility also in cryptocurrency exchange rates. With volatility comes risk, and this gives rise to an inherent issue: trust. Can we trust cryptocurrencies? In recent times, we as a firm have seen an increase in interest from our high net worth clients in the use of crypto assets, and our professional trustee clients are also seeking advice as to how to deal with requests that they are custodians of crypto assets. Our session today aims to discuss and explore some of the key risks and considerations our clients are going to need to grapple with to ensure that investment decisions and wealth structures holding crypto assets are sound, and that these structures preserve and grow the assets rather than jeopardize them. The webinar will be recorded and will be available for viewing on our YouTube channel in the coming days. Following the discussion, there'll be time for questions of our panel. So if you have any questions, please do pop those into the Q&A function so we can pick them up and address them at the end of the session. But without any further ado, let's kick off. If I may come to you, Chris, to begin the session, please. What are some of the challenges, do you think, in using a trust to hold crypto? And how do you think these risks can best be managed?
Thanks, Lucy. Thanks, Lucy. And nice to be on the panel with you guys. I think the overarching challenge for trustees being asked to deal with crypto starts from a lack of education. Just get scared by the concept of doing it. But when you sort of dig into it, there are risks, but they can be managed. The main risk really is custody. Trustees are going to usually be nervous about holding crypto. They're worried about being hacked, losing the private keys. And so most of the conversations that I have with trustees are, we're happy to take this on, but we don't want to deal with custody ourselves. And so fortunately, there are a range of solutions in that respect. So there's institutional custodians. So a trustee could set up an account in the name of the trustee, but custody dealt with by someone else, so that the trustee isn't personally responsible for loss of the asset. There's self-custody, where the trustee could literally hold a hardware device, but it may be nervous about doing so. There are derivative products. So if the trustee doesn't want to think about custody at all, investing in a fund is a good idea. If the settlor is happy, you could have the trustee hold an exchange account, but there's risks in that. If the exchange gets hacked, the trustee could be left holding the baby, so to speak. And for lots of the settlors that I speak with, they're very keen to set up a trust, get the benefits of the trust. But when I tell them you're going to have to part with the assets and the control, that stops a lot of conversations. So there is a sort of tension in finding a solution as between trustee and settlor where both parties are happy with the arrangement, because the trustee doesn't really want the custody, settlor doesn't really want to part with it, and so it's just working out, what's a way of doing that, and lots of settlors, crypto settlors that have sort of got in early. One of the sort of main tenets of crypto is it's you don't need any counterparty risk, and so any scenario which sees someone part with their crypto to someone else they don't necessarily trust, could be seen to be introducing counterparty risk. So that's, it's a challenge, but it's surmountable. And I'm setting up a number of trusts at the moment where, we're using various solutions I've just discussed to sort of manage that risk. One of the other risks is Aml Source of Wealth. So trustees being asked to take on crypto assets or crypto proceeds are, slightly hesitant about, should they, what are the risks, could they be, fall foul of anti-money laundering regulations, those sorts of things. And I think that comes from a place of people thinking that crypto is anonymous, so it's not trackable. Whereas actually for most cryptocurrencies, they're pseudo-anonymous. So the identity of the owner of the assets is hidden effectively, but they're otherwise trackable. So that can actually make source of wealth easier to establish. And it's fascinating. One of the problems we have on non-crypto structures at the moment is dealing with source of wealth for very old money. And how far do you go back? And it can get very hard to verify the provenance of wealth, that's multi-generational. And so, arguably crypto and, new money and new wealth is actually better if you can track the source of wealth, because you can be very confident it's legitimate. So that's one challenge. And then the other main challenge really is around investment risk and volatility. So a trustee, is going to be mindful of the savage swings that cryptocurrencies can have in value, and making sure they're not responsible for that. So I mean, that's a risk that comes up a lot, or just, in discussions that I have with trustees, but actually with tailored drafting, with clearly defined roles as to who's looking after the crypto, like in terms of the trading, who's responsible. In Cayman trust, you can obviously have reserved powers. So often, there'll be a formally appointed investment advisor, which can direct the trustee as to crypto investments, thereby, basically mitigating the risk to the trustee of being held liable for a decision where an investment goes bad. So that's a risk that's very manageable. And then commonly, the investments would actually be held by a holding company where the trustee doesn't provide the directors. So, that's another way of sort of managing that risk. So trustee holds shares in company A, and company A holds crypto or custodial account or whatever else. So that's a way of managing that risk.
Thank you. And when thinking about the trust structure itself, would you recommend using a new trust structure or an existing trust structure to hold crypto assets?
Definitely a new structure. Yeah, I mean, it is possible to shoehorn an old trust, and make it fit for purpose, but I think you end up probably spending more money and time doing that, and you probably end up with risk and uncertainty where you haven't quite thought about how some obscure provision in an existing trustee might impact decisions around digital assets and crypto. And so I would be telling people, use a new trust, make it tailored, express provisions to hold crypto and digital assets, express provisions to be able to engage in crypto related activities, so DeFi, staking, yield farming, all these weird and wonderful things you can do with crypto. And so you can build a trust deed that that expressly allows for that, builds in exoneration provisions for the trustee, puts limitations around, you can have limitations around leverage. So if for instance there is a holding company engaging in the trading, a restriction imposed by the trustee as to not using leverage when they're trading, those sorts of things to minimize risk. And you can have all sorts of provisions really around how the trust should operate and its investments. But definitely, I think newer is better and probably cheaper. And yeah, I just think, particularly with older trusts, it's just going to be more risky trying to, you're going to have to do a wholesale amendment anyway. So I think why not use a new trust?
Start afresh. Yeah. Brilliant. Thank you. Leigh, if I could come to you now, please, where we're looking at trusts that are governed by English law. What particular factors do you think the trustees need to have in mind when considering crypto assets as part of their investment strategy?
You're on mute, Leigh.
Good afternoon, Lucy. So I take on board the things that Chris has just spoken about, creating new trusts and starting fresh. And I agree with him that that's important. Let's take, for example, Section 3 of the Trustee Act. This provides that a trustee can make any kind of investment that he could if he was absolutely entitled. The problem with that is that the word investment in that section requires that profit or income is expected. The basic crypto assets, the cryptocurrencies like Bitcoin and Ether and Litecoin, they don't have income. So if somebody is investing in that and they don't expect the price to go up, at the moment, for example, the price of cryptocurrencies is fairly flat. And so they might not be investments for the purposes of Section 3. And so a tailor-made investment clause is a good idea. There are some crypto assets, of course, the modern crypto assets that are involved in the DeFi systems where income is expected, and that's clearly an investment. The second important section from the 2000 Trustee Act is Section 5, and that requires trustees to take advice about investment and retention of crypto assets. And this could involve two pieces of advice. First, the trustee would probably take advice from a general investment advisor about how much crypto assets should be invested in, because to invest the whole fund in crypto assets it would be unusual. And so that would be one piece of advice. The second piece of advice would be a crypto asset specific advice, because the general advisor is almost certainly doesn't know much about crypto assets. And so you have to find somebody who does have knowledge of crypto assets. And the other thing that Chris spoke about was the difficulty that's faced, that the trustee faces with the wild swings in value of crypto assets. And so the Section 1 of the 2000 Act, which provides for a statutory duty of care, needs to be dealt with. And I agree that Chris's solutions would probably work in England, although care must be taken that the set law is not completely in control, so that it's not really a trust.
Thank you. And what about the risks when that need to be considered when planning for an estate containing crypto assets, and how can those risks best be controlled, do you think?
Well, there are a few important risks, and they are fairly simple ones. The first one is that the private key needs to be kept private. I've had a case where a solicitor said to me, well, somebody just died and I've got a private key here. Who do I give it to? You know, is there a registrar, company registrar? And that's just not the way you look at it. The private key needs to be private, because with knowledge of the private key, someone can transfer all the crypto assets out and give it to themselves or send it to whoever they want. And clearly the executors don't want that to happen. It's also important not to lose the private key, because unlike other things that people are used to on computers and on the internet. There's nobody to call to get a replacement private key. There's nobody in the middle between the owner and the system. If you lose the private key, you may lose all of the crypto assets that are associated with that private key. And so it's important not to lose it. In the same way, it's vital that steps be taken to enable the personal representatives of the crypto holder, firstly, to be aware that there is crypto in the estate, and secondly, to be able to gain access to it and control it after the death or incapacity of the holder. There are several techniques for this, and they range from simple, where the private keys are written down, or what is better, where the seed words from a wallet are written down and put in a safe place, and the executors are told where to find that. There are also techniques like having 2 or more people able together to access the crypto assets after the deceased's death, and that's called a multi-sig. Finally, although crypto assets have been in existence since 2009, the whole concept is still actually experimental, and computer programs can fail. There can be weaknesses in the programming code of the system, and if a user is able to control the whole system, then he can take control of the value that people have in that system. The Bitcoin system is generally considered to be very strong, but others might not be.
Thank you. That's great. If I could just ask one more question of you, Leigh, about regulation. What regulatory matters need to be considered by trustees when they're holding or considering investment in crypto assets?
So there are a few. One of the problems, it's not really regulatory, is that many crypto assets, like Chris was saying about exchanges, get hacked, and crypto assets like Bitcoin mainly have been stolen by hackers. And under the general law, a stolen item generally tends to remain, the ownership of that item remains with the original owner. So if somebody later gets that asset transferred to them, they don't really know whether they actually own it. That's a problem that exists, and it means that some Bitcoins or crypto assets are more valuable than others, although people aren't aware of this. There are businesses who are able to trace crypto assets from thieves, and their services need to be used if the holding is large enough. An investor in crypto assets will not have access to the Financial Ombudsman Service or the Financial Services Compensation Scheme if something goes wrong. And so you need to be aware of that. If you lose your crypto assets, you will lose them. The trustees should ensure that any exchanges or custodians that they use in the UK are registered with the Financial Conduct Authority, or until July 2021, when that has to happen. And they will have had to apply to be registered at the end of last year. There are not many businesses not many businesses have been able to get registered, and this is a problem for the FCA. Finally, the anti-money laundering regime specifically includes transactions involving crypto assets, and so all the usual techniques that are employed for that need to be applied to crypto assets.
Thank you. And Chris, if I could just come back to you, what sort of demand are you seeing in Cayman for trusts to hold crypto? Is there lots of demand, or is it?
Yeah, there's actually over the last, I'd say, year, we've just seen a real influx, and So much so that I think probably more new structures have a crypto element than not. Even if it's a new big family office for traditional money, there will still be and we would like to have the ability to invest in crypto or hold crypto or whatever else. But yeah, so we're seeing a range from trusts for, people that, got in early to Bitcoin and other things, they want to directly hold a particular crypto asset. Also seeing some sort of offshoots of that where people have made money in crypto. We've got a client at the moment who's a crypto YouTuber and makes a ton of money from YouTube, and so is setting up a structure for the YouTube revenue that pours off, setting up structures for a crypto miner, so the income that they get from mining Bitcoin, which is quite interesting. Setting up a new family office for a founder of a crypto exchange, and so that's not necessarily going to hold crypto, but it's, there's still some sort of crypto elements to it. And then we're doing quite a few commercial type vehicles, mostly through Cayman Foundation companies, for token issuance and those sorts of things. And so there definitely is demand, and so much so that I've even had a couple of requests to accept Bitcoin for our fees, which I've obviously had to say no to at this stage. And then the next question is, will you take US dollar stable coins? No, US dollars would be good, but
not legal tender yet.
Yeah, exactly. So it's but yeah, it's really changing and quite quickly. We get a lot of inquiries that go nowhere, but there's actually we are instructed on quite a few matters as well. So yeah, it's really interesting to see.
Fantastic, exciting. Right, moving to Marilyn, if I may. Tax, Marilyn. Where do the UK tax rules for crypto assets come from?
Well, first of all, good afternoon, everyone. And the short answer to that question is that there are no rules. Crypto assets they're a new kind of asset. There's no case law or legislation specifically on how they are to be taxed. And from time to time, HMRC produce some statements on particular aspects, and that has now been drawn together in a publicly available cryptocurrency manual. So to the extent that there are any tax rules, it comes from the HMRC crypto asset manual. And there's a few preliminary points that are worth making. First of all, HMRC do not regard cryptocurrency as money or currency, which has implications for the tax treatment. Secondly, the Crypto Assets Manual does not apply to derivatives of cryptocurrency, so futures and options, to which the normal rules about derivatives do apply. I mean, HMRC take the view that normally trustees, and indeed, individuals, but certainly trustees, will normally be holding crypto assets as investments. So they will be within the capital gains tax net. If the trustees were, if the activity of buying and selling and the organisation and volume of it amounted to trading, then they'd be subject to income tax on trading. Also, if the trustees did take part in activities like mining or staking, that the proceeds from that would be regarded as miscellaneous income, and the rules for what you can deduct as expenses from that kind of income is quite limited. Things like airdrops would not normally be considered as income unless the trustees are giving some sort of services in return for that, which is unlikely. And the other preliminary point is that crypto assets would be an asset for inheritance tax purposes.
I see. So how would the trustee be taxed on crypto assets?
Well, that depends on whether they're UK resident or non-resident. So if the trustees are UK resident, then they will be taxable in their own right on disposals to capital gains tax if they're carrying out any income type activities on the income, and they'll be, well, residence of the trustees doesn't really matter for inheritance tax. As we know, it's the domicile of the settlor and the location of the assets. If the trustees are non-resident, then by and large they won't be certainly won't be subject to capital gains tax. In relation to inheritance tax, it depends on the situs, on the location of crypto assets. And HMRC take the view that where the crypto assets represent an underlying real asset like gold or fiat currency, then it's where the actual asset is. But in the normal case, Bitcoin, Ether, that sort of the exchange token type of situation, they take the view that the asset is located where the owner resides. So if we're looking at offshore trustees, the cryptocurrency will be located where the trustees are resident, i.e. offshore. So in the non-domicile context, the trust is capable of being an excluded property trust. And sorry, so yeah, no, if they were receiving income, the offshore trustees would only be liable if the income was UK source. And that is something that the manual is totally silent as to. So there are no rules for determining what the source of income is and therefore how it would be taxed on a non-resident. When it comes to stamp duty, SDRT and SDLT, the revenues, and they describe it as their current view, which is interesting, is that crypto assets are not stock marketable securities or chargeable securities, which means effectively there's no stamp duty or SDRT on their acquisition, because if you're buying shares, for example, you'd pay SDRT when you bought them. But because cryptocurrency is not any kind of security, in the HMRC's current view, which suggests they might change their mind at some future date if it suited them, there's no actual tax on acquisition. But although it's not money, it is money's worth. So if you bought your house with Bitcoin, you would be giving money's worth for the house and you would pay stamp duty land tax on the value of the Bitcoin used. So does all that make sense? Roughly.
Sort of, yes. I'll leave the tax to you. And what about distributions to beneficiaries? What are there special tax considerations for a trustee there?
Yeah, well, particularly for offshore trustees. I mean, looking at now at non-resident trustees who won't normally be subject to tax on the crypto, it doesn't mean they can ignore the tax. Gains and losses on crypto will form part of the stockpiled gains in the trust capable of being taxed on UK beneficiaries who receive distributions from the trust. And similarly, if the trustees do have any crypto receipts which count as income, that will be relevant income, which can also be taxed on UK beneficiaries who actually get something from the trust. I mean, there could be issues. I mean, Chris mentioned situations where, you know, settlors are engaged in mining activities and so on. If you had a settlor, say the settlor had a company and they were working for the company, producing income from cryptocurrency, and the trustees own shares in the company, you know, what is the source of that income? If it's UK source income, then the trustees and or the settlor might be taxable on that income. So if the trustees are holding income, if they're holding companies in which have UK source income in them, that can have direct tax consequences for the trustees. And there's a particular issue with distributing crypto. I mean, first of all, a distribution will be a disposal, so that can trigger a gain or indeed loss on its own, which will add to the amount that can be taxable on the beneficiaries. But if you're looking at HMRC's view that the crypto is located where the owner is, then if the trustees distribute to a UK resident remittance basis user, there's going to be an immediate tax charge, because as soon as the crypto comes out of the trust and it goes to an owner who is UK resident, it becomes a UK asset, and therefore there has been a remittance and the owner might be taxable. Now, it may be possible to get around that by holding the crypto through an offshore company, and you distribute the company, which is a non-UK asset, so no immediate tax charge. But as soon as you try and extract funds by way of dividend or on a liquidation, if the owner is still in the UK, if the beneficiary is still in the UK, there's going to be potentially tax consequences for them. So it can be quite tricky. Trustees need to think it through.
Does that cover how gains are computed, or how are gains computed?
Well, again, there's quite a lot in the crypto manual about that. So in order for there to be a capital gain, a capital, or at least there's got to be a disposal in order to trigger the capital gains tax rules. But that can include using tokens to pay for goods and services, and can also include, as I've mentioned, distributions to beneficiaries. Now, for capital gains tax purposes, you have to compute your acquisition and disposal values in sterling. So, many of the cryptocurrencies are basically not dealt in sterling. They might be dealt in dollars. So, if you've got to buy and sell dollars, you've got to do all the currency exchanges when you're working out what your acquisition cost is in sterling terms and what your disposal proceeds are in sterling terms. Where it gets trickier is if you exchange one kind of token for another, because you need to work out what the value of the transaction is. And I will read you what it says in the manual about valuation. If the transaction does not have a pound sterling value, for example, if Bitcoin is exchanged for Ripple, an appropriate exchange rate must be established in order to convert the transaction to pound sterling. Reasonable care should be taken to arrive at an appropriate valuation for the transaction using a consistent methodology. Details of the valuation methodology should be kept. And that's it. So it says absolutely nothing at all about how you actually go about valuing the currency in this situation. And expenses of acquisition and disposal are deductible, and there's a handy cut out and keep table in the manual which sets out what expenses, so particularly exchange fees, HMRC will allow. So while they won't allow fees charged for depositing and withdrawing cash, whether that's in sterling or another fiat currency, fees charged for investing into crypto assets or exchanging them or disposing of the assets will be deductible as an acquisition or as an acquisition cost or a disposal cost. Now, where you exchange one crypto token for another one, there'll be a composite fee, but you can only have one deduction. So generally, HMRC say you can divide it between an acquisition cost of the one you're buying and a disposal cost of the one you're selling on a just and reasonable basis, which is effectively 50-50 in their view. If you can use tokens to pay the exchange fees, but that will be a disposal in itself, which will generate another gain or loss. So it sort of all becomes quite regressive. As far as identification of which of your tokens you're buying and selling, then there's a pooling, it's the same pooling arrangements as apply to shares. So all your Bitcoins and all your Ether will be in different pools, and you have a composite acquisition cost, and then you have to calculate, what proportion of the pool you're selling each time you make a disposal. And bed and breakfasting applies as well, so you can't sell and buy back within 30 days. They do helpfully say that should your your Bitcoin plummet to zero value, you've probably got other things to worry about, but you can at least make a negligible value claim, which triggers an allowable loss that you can set against other gains. And if you lose your private key, and there's no possibility or no reasonable possibility of gaining access to the tokens, then again, you've probably got other things to worry about, but at least you can make a negligible value claim and crystallize a loss which you can use against other gains if you've got them.
Right. So how on earth does trustee go about keeping records for tax purposes in this context then?
Well, it's going to be down to the trustees. The Revenue are very firm on that. It is not up to the exchanges to keep the records. It is up to the trustees to keep the records, and they will want they may ask for downloads of wallet information about balances and transactions. They'll be looking for bank statements showing money being used to go into the exchange to buy the tokens and money going back into a bank account if you dispose of your tokens. The trustees will need to keep records about the type of crypto asset they're buying and selling, the date of the transaction, number of tokens involved, sterling value at the relevant date of the transaction, and bank statements and wallet addresses. So those are the things that the trustees are going to need to think about.
And do you think that, I think what you're saying is the tax treatment, is it clear now we have HMRC's Crypto Assets Manual? Or?
Oh, absolutely not.
Far from it. Yeah.
Far from it. I mean, as I've said, as we've been going along, there are a number of gaps. There's no real guidance on valuation. There's nothing at all about the income source. Doesn't say what expenses can be deducted from miscellaneous income, where you have where it's income rather than a capital gain. I mean, although HMRC start by acknowledging that there are different kinds of tokens, so you've got your exchange tokens, utility tokens, security tokens, stable coins, most of the commentary in the manual is about exchange tokens, things like Bitcoin. And there can be issues about categorization of tokens, and we don't know whether they will regard the tax treatment of the other kinds of tokens as being the same as exchange tokens. So more uncertainty there. And importantly, the manual is not the law. It is HMRC's current view of the law. And on an issue like Situs, it doesn't seem to have been put together on a reasoned basis from first principles. It seems to be, well, it sounds reasonable and we can't think of anything else. But there are possibilities other than where the owner resides, and I know Leigh has some views about that. So Leigh, perhaps you could share those views about Situs with us.
Sure. If I may, before I get there, one of the things that you said about the guidance being limited to exchange tokens is very interesting, because the new decentralized finance systems are, each system has its own structure, and the tax on those is going to have to be dealt with by that structure. And these structures also have things like derivatives and options and futures, and those things will come into play there. Anyway, so with the Situs rules, of course, an intangible thing like a crypto asset has no Situs, and the law has had to deal with these things in the past, like debts and other things in action, and it has to impose some kind of legal Situs, legal location, according to certain rules, and generally it relates to enforcement and recovery. Where there's a debt, it's located where the debtor is and where the bank account is, things like that. For a crypto asset, that, I say, involves control of the private key. And it seems to me that that should be the starting point. Things with an exchange token, which is a fairly simple thing, that I think that's probably the end as well. And if the private key is in Switzerland, locked in a location there in a bank vault, and the non-dom resident in London doesn't know what the private key is, it's my view that the location is in Switzerland. It's going to be nuanced. It may be that there is a residence thing as well, but one of the problems is if you have a custodian sitting in the Cayman Islands, and Chris has just drafted some amazing documents for that, and they're holding a crypto on bare trust for the non-dom resident in the UK. Why should the location of that crypto be in the UK if the custodian is located in the Cayman Islands, and he's controlling the wallet, and he has the private keys in the Cayman Islands? And I know that the revenue are against changing what they're doing, but I think that at some point it's going to come to court, and we'll see what the result is. With the DeFi systems, the location may change because they involve contractual relationships between the user and somebody, which may be people who are providing liquidation for the system, or they may be having a contract with the people who are controlling the system, like the MakerDAO is controlling how the DAI interest system works. And so once you've worked out where those contracts are, which happen off-chain, then the location of those transactions will be determined in different ways. But you must remember, of course, that for capital gains tax purposes, it's not necessarily the common law that applies. It's necessary to look at sections 275A to C of the 1992 Act, which talk about intangible assets, and they're talking about where the asset is created. If it's created in the UK, well, that's where the location is. And so you have to work out, well, where was it created? Was it created at the location where the miner received the assets on the processing of the block for which he won the puzzle? But those questions still have to be determined, and they're going to be really interesting.
Absolutely, thank you. Thanks for those comments. Helen, if I could come to you now to discuss some of the practical considerations underlying tax compliance in relation to crypto. What need we be aware of?
Thank you, Lucy, and good afternoon, everyone. Well, I think it will have become obvious from everything Marilyn has said that cost is going to be a large practical factor, because you're going to have to take advice in relation to the investment side of holding this asset. You're then going to have to think about Situs tax treatment in different jurisdictions. And, we've only touched on the UK, obviously, because that's what we advise on, but it's clear that our manual leaves some questions unanswered. There's going to be the cost of doing the computations, the cost of the valuations, the cost of doing all the exchange rate movements, plus all the record keeping that's going to have to be done. Now, trustees, particularly in the offshore world, routinely have to face the kind of tension that arises when you have beneficiaries from different tax jurisdictions. And in a way, they are used to dealing with this. I also think that in certain jurisdictions like Cayman, as Chris has explained, they are getting much more used to having these assets and will be working out systems for dealing with them. But it is, practically speaking, it's a new technology, it's a new asset, and trustees are going to have to work out ways of dealing with them and giving beneficiaries the data that they need in order to do their reporting properly in their own jurisdiction.
Thank you. Are there circumstances where it might be better from a beneficiary's perspective to leave crypto assets in trust for tax purposes, do you think?
Well, if we look at a non-dom UK resident beneficiary, I think it will be, you know, everyone will have gleaned from what Marilyn has said that other things being equal, it may simply be better to leave the asset in trust as long as you can. I mean, the difficulty is that a non-dom UK resident beneficiary who receives an asset on which they have to pay tax may find that the asset has plummeted in value by the time the tax is due. And that relates to the volatility of these assets, which Chris explained at the beginning. Conversely, if the asset rises sharply in value, then why take on the potential exposure to inheritance tax that you'll have as long as you're resident in the UK and the associated estate planning problems? Also, it may be easier for an asset to be directed to another beneficiary through the provisions in the trust, rather than another beneficiary receiving it outright and then making a lifetime gift while they're in the UK, which would be a potentially exempt transfer. So it's a question of balancing up the pros and the cons. It's probably no different for this asset than any other asset, except that the situs seems slightly unusual at the moment. And it's also because, as I say, it's a new asset. You've got the volatility factor.
Absolutely. And a question that comes up is, how would a trustee approach taking an indemnity from a beneficiary receiving crypto?
Well, I mean, I think there are various points here. If a beneficiary receives a distribution and crypto assets are involved, then the transferor trustees are going to have to take into account the volatility of the value of these assets in particular. And so wording which ties the indemnity to the value of the crypto asset for the time being might be problematic because there might be exposure there. So trustees would have to consider their liabilities very carefully and what their potential exposure is, which actually, to be fair, they should be doing anyway when they're seeking an indemnity from a beneficiary. But the standard in the industry is often that you take the indemnity anyway. So they'll have to think about that. I mean, it would be equally true if you had an inter-trust transfer where indemnities were involved. I mean, Chris explained that you're usually better off with a new trust because an old trust may not have the right provisions. And that might be true if you were actually making a distribution to a transferee trust. You'd have to check that it's got the right express powers and so on. But we often are in an environment where we can't always say we want everything new. You know, families may have lots of trusts, lots of structures. Someone may have the idea that you want to actually put it in that trust over there, which has already existed for some years. And then you would have to check that you could actually accept it. And the transferor or trustee again would have to think about the indemnities that they took. The other situation where indemnities come into play is when there's a change of trustees, and standard templates there often allow distributions by the transferee trustee by reference to a percentage of the value of the trust fund at the end of the previous accounting year. And I think that might have some exposure given the volatility of the assets. I think have to bear in mind that none of these are new issues for trustees. They're just coming into sharper focus because of the volatility factor. And also, I suppose, as Chris has said, because everyone is not so familiar with these developments and these particular kinds of assets.
Thank you. And what about charities and charity trustees? Where do they sit in relation to accepting crypto assets? Can they receive them as donations?
Well, it's very much a developing area. I mean, I think the sense I get is that charities don't wish to be left out of the possibility of a way of boosting their funds, but they're going to need to be comfortable with who is making the donation and with some of the ethical and environmental concerns that can arise in relation to these assets. And they also need to have the infrastructure to deal with the donation, and they may not necessarily have that. But I suspect it won't be long before developments speed up in this area, because the possibility of losing out on a donation or an asset is, you know, charities will have to think very carefully about that.
Absolutely. Thank you. Well, thank you all for your very insightful comments. I'm sure we've all learnt a good deal this afternoon about what trustees need to bear in mind. Just looking at the Q&A, we do have some questions, and I will, if I may, read those out and ask if anybody would like to answer them. The first question is, what is the difference when estate planning in relation to holding crypto on an exchange, Binance, Coinbase or Uphold, rather than through a cold wallet? Is succession planning easier if held on an exchange? Who would like to answer that question? Leigh, would you feel comfortable?
Yes, I can answer that. I think that holding it on a cold wallet, which would normally be a wallet that's contained in a USB key, is much easier. First of all, you can hand over the key and give the password and the seed words, as I said, locked in some safe somewhere. And that would be, the transaction would be complete. If you have an account with some cloud service, which is what an exchange is, then you have to go through the terms and conditions of the cloud service, and you have to negotiate with them to get hold of the value of the holding. And you know, that may take, in some jurisdictions, that may take court orders, and in some jurisdictions it may be impossible. If the exchange is situated in China, it may be very difficult, and you have to take advice from a lawyer in China, and you have no idea what's going to be involved in that.
Thank you. Another question we have is, if you had a trust which holds the majority of its assets in Bitcoin, the intention for which is to hold long term, would it be fit to report any financial information with a Bitcoin value rather than a US dollar value or pound sterling value? That is, negating the impacts from any fiat currency volatility. Would Chris or Marilyn perhaps want to answer that one?
Yeah, I mean, I imagine that's going to come down to the requirements of the person you're reporting to, as to how you report. I imagine, you know, if you're reporting for a tax perspective, you know, in the UK, they're going to probably want the GBP equivalent, but I guess I'd leave to the tax experts to answer that one.
Yeah, I mean, if you're talking about tax reporting, then it's required that you report in sterling. So you would have to do the conversion. But if it is simply being held in the trust long term, then as Chris said, it's whatever suits the settlor stroke beneficiaries. There's no particular need to convert it to any particular currency.
Great. We've got about 4 more questions to get through, so I will rattle through them. Another question is, how would ownership of crypto be treated in situations like buying through Revolut, where I understand you don't actually own the crypto? Is this treated more like a foreign exchange rather than an investment?
Can I answer that, Lucy?
Yes, please do.
I think this is a cloud service. You know, although they're your bank, they providing a custodian service to you, and you have to look at the terms and conditions of the contract between you and Revolut. They probably say that although the wallet that's controlling the crypto is controlled by Revolut, who holds the private key, the terms and conditions probably say, I haven't checked Revolut, but most custodian exchanges say this, that they hold it on trust for you. And so that is probably what is going to happen. There's been a case in New Zealand where an exchange became insolvent, and that was one of the terms of the contract, and the judge there said it was a bear trust, that they held the crypto on trust for them. So it's an equitable interest in the trust asset.
Thanks, Leigh. Another question. Have the panel come across any issues that trustees are facing with their insurers for PI coverage in relation to holding digital assets?
I think, if I can jump in on this one, I think some trustees probably aren't allowed per their PI insurance to provide self-custody. But I do know of trustees that are, they have taken possession of the private keys. So I guess it's going to depend on the terms of each trustee's PI insurance. But yeah, it's certainly worth bearing in mind. What you don't want to do is accept custody of something that you're not supposed to accept custody for, and lose your insurance coverage as a product.
Thank you. Another question, if I may, is a private key a chattel? Discuss. Anybody want to volunteer an answer to that? Marilyn, would you say it is a chattel?
Very good question. I suppose if it is in the form of a USB, that is a chattel. Whether the information it contains, because really this question of, are you looking at the physical object, the USB key or the piece of paper with it written down on, or the information? And I don't know the answer to that one, but it is a very interesting question.
We have one of our colleagues to blame for raising it. Yeah. I'll name them after the session.
Right, thank you. Yes, I will take it up with them.
Yes. Another question we have is, do we have any idea yet as to how you would treat loss of, for example, Bitcoin, via leverage trades for capital gains tax purposes? Say if you use an exchange like BitMEX to stake Bitcoin on leverage trades and the trade goes against you and you get liquidated and your Bitcoin is taken as collateral, presumably that would be nil consideration disposal out of the Section 104 pool? Question mark. Leigh, do you have any comments on that?
I don't know. If you had a diamond ring in the same position, I suspect, if you were borrowing money secured to buy a diamond ring, and the diamond ring was used as a security for that loan, and there was power for the mortgagee or the chargee to sell the diamond ring if your collateral, if the diamond ring went below its value or something, then you would treat it in a certain way. And I don't think that holding crypto assets would be different for that.
Thank you. We have one more question. Given the volatility of crypto assets, there could be instances where an estate valued at the date of death loses significant, if not all, its value before inheritance tax becomes payable. Has there been any indication by HMRC whether claims for loss may apply in a similar way to loss on sale of shares?
Well, certainly there's nothing in the manual about that. I mean, there is obviously specific relief where shares are sold within a year of death and realise a loss. But in the absence of specific legislation, I can't see that it would apply at the moment. So that is another risk on the volatility front. Unless, of course, HMRC changed their mind about treating crypto as securities.
Indeed. Anything can happen, it seems.
Absolutely.
Marvellous. Well, that comes to the end of our questions. And so unless there are any more or any other further comments, just remains for me to thank you all very much indeed for attending. I hope you found it a useful and informative session. We are running the second in our series of these webinars this time next week, 4 p.m. Thursday, June 17th, where we'll be addressing more contentious aspects arising in relation to cryptocurrencies, such as reputational issues for trustees, hacks and scams, tracing trust assets and litigation generally in relation to crypto assets. So we do hope you can join us for that session too. But good afternoon to you all. Thanks for attending.